My name's Vince Jaramillo. Sorry, I'm just not trusting that we're working out. Anyway, I'm born and raised Catholic, born and raised here in Colorado, a Denver native. I've got 4 kids and my lovely wife. That happens to be a picture of us in California in the Redwoods area. Beautiful place. So if you ever go, enjoy it, but then when you come back to Colorado, you'll think all the trees are so tiny. It's just amazing to see those trees. I have more than 25 years as a CPA and accountant. I founded my own firm after working at another CPA firm for 18 years and another firm for 8 years. Most of my work is working with individuals, businesses, nonprofits, trust returns, state returns. I do pretty much everything a CPA does. I don't do payroll taxes. I refer that out, and same thing with bookkeeping work. But if you have any tax questions, I can answer those. I also do, 40% of my work is also doing financial audits for churches and nonprofits. I do audits, reviews, and compilation work for N990s for nonprofits. And I have a few different parishes down in Colorado Springs, and then some of them are Christian, and then some of them are just, you know, they're not any denomination or anything like that. So wisdom, faith, and practicality. Hold on one second. I need this. Sorry, that's what I was looking for. So anyway, some of the highlights that we're going to go over is the One Big Beautiful Bill. You'll sometimes see it as OBBA. We're going to go over business and family impacts from that. Just briefly talk about good records, charitable giving as a stewardship, a retirement account, and we're going to have a little mini workshop within that, and then estate and legacy planning, and then I'll just tie it all up and then open for questions and that you guys might have. Some highlights of the bill. Anyway, the cartoon says, you want a tax cut, write a check to the government and drag it across your finger really fast. So sometimes that's how it feels like. This particular bill purpose was designed to simplify and for simplification for small businesses and relief and middle class incentives. So it also continued what we already had, but it also gave some different things. There's been some things they did not continue, like the health care. They're still trying to figure out what they want to do with that. For individuals and families, what we have here is the home mortgage interest deduction. That's still deductible, and that stayed the same thing. HELOCs, some people think, well, if I just get a mortgage, I'm able to deduct all of it. If you get a HELOC, you're not able to always deduct that, depending upon how big your house is, and also if you have used it for other things. So if you go buy a car with your house, that's not going to be deductible. Other things, the big change though is the state and local tax deduction. It was limited to $10,000. So if you had your property taxes, you had your state income tax, and it might have been $20,000 or $15,000, you were limited to $10,000. Now it's gone up to $40,000. So that's helpful. It doesn't get everybody there. That's some of my higher income people, but it takes it a lot farther than what it was. And there is a typo that should be starting in 2025. There's that piece limitation. That's if you make way more as a married couple, like $760,000, there's some cutback on your itemized deduction. And then the personal exemption, that's still been eliminated, but because the standard deduction is so big, it hasn't really negatively affected most of my clients. I'm big on cartoons, so sorry. You can pay me next year. My tax guy advised me to defer my income. So that kind of advice I usually give when we're transitioning tax rates. We stayed at the same rates. Sometimes I'll give my clients to accelerate their expenses, things like that. But let's give some more practical advice with what's going on. So what we have here is the corporate income tax rate. That stayed the same from what we had. It had before this. Before 7 years ago, it was at 35%. So if you're a C Corp, your taxes still remain low. If you're a pass-through entity, that income goes down to your individual tax return. So pass-through is an S Corp or a partnership return. So some LLCs are S corporations, some are partnerships, and some are disregarded entities, which means it just goes on your personal return. And then the estate tax, I just threw that in there. If your estate's worth $11 million, now it's gone up to $15 million, and you'll have this huge tax you have to pay. I'm guessing most of us aren't in the $50 million range, but you're a little safer now. The 179 deduction, that was something that was now permanent, as permanent as things are for the federal government. Any Congress could always change this, but you're able to take 100% of your equipment or furniture or whatever you bought for your business as a deduction. Real estate you can't take, but it was going to start going down on how much you could take. Another cartoon. Congratulations, it's a tax credit. So we as Catholics don't look at our children as tax credits, but since we're now here and are taking care of our children and wanting them to go to heaven, we do have a credit that comes along with them. So some of the credits are the child tax credit, but there's also, I'm going to start from the bottom, individual savings credits, or also called TREMP accounts. So if you have a child born in 2025 for the next 3 years, a new child born in the next 3 years, they'll deposit $1,000 into an account for them. And then when they turn 18, whatever they've put in it or you've put in it for their behalf, plus that $1,000 they can take out and use for college or use for whatever. I'm not sure if it's the best thing, but if it's $1,000 for free and you had a child born this year, take it. The other things is for employers, there's been some enhancements to the employer child care credit and family leave. There's been some improvements for other work-related credits. I'm sorry, I think I missed something I was going to talk about here. Sorry, the QBI, I'm back to business for a second. So that was the one that, it's a double deduction for businesses. So if you're an S Corp or a Schedule C type filer, or you have rentals, you get your deductions for your expenses, but you've been able to take another deduction for all those expenses of 20%. So they continued that was going to go away, and sorry, I just wanted to make sure I went over that one. Some other tax changes are for seniors. Basically, you get a $6,000 additional deduction, and then as your income starts increasing, that deduction starts evaporating until it's completely gone. Similar thing with tips, that's a $25,000 annual deduction. So if you happen to be a tip person and then you're a gig worker or something else that, you might have some different things going on. Overtime, it's only $12,500 per person. So if both of you have overtime, you can each take up to $12,500. And then car interest, that's a new one. I'm not sure how much this will really come into play, but if it's assembled in the U.S., you're able to deduct $10,000 from your taxes, but that also phases out as you make more income, either as an individual or as a married couple. Did want to briefly go over good record keeping. My cartoon again. My first recommendation is to get a bigger shoebox. So you want to bring me your tax records, or any CPA, your tax records. That's the forms like the W-2, the 1099s, your P&L or your balance sheet, things like that. But you really don't want to bring every single receipt that you had. I've had clients where I had one client, he'd always bring me his Air Jordan box, his new Air Jordans. I got to see his new box every year, and I'd tell him, hey, this is going to cost you money for me to go through this box. He said, oh, don't worry about it, Vince. I don't mind paying you. It's better for you to go through it than me. And that's what I would do. Learned a lot about his life, along with his rental expenses. But it also helps reduce what you have to pay to an accountant if you're just bringing that type of stuff. Now, as an accountant, I may ask for closing documents, things like that, if you bought a house, sold a house. But it's good for you because, you won't remember what happened 3 months ago, 6 months ago. So if you have good record keeping, put all your charity together, put all your business records together, put it in QuickBooks, put it in a spreadsheet, and that's going to be better for you than trying to remember, oh yeah, I think I went to a business meeting in January, how much did I pay? And so you're kind of fumbling through, and you're going to miss deductions that you're entitled to. The IRS is always going to charge you taxes on your income. They're never going to remind you of any lost deductions. So do want to make sure that you're doing good record keeping. Compassion Today, are you a tax-deductible charity? That's not why we want to give. We want to give because we want to plan to be generous. We want to give because God has provided for us, and so that we can provide for our family and provide for our church, but we also want to plan how we're given. And so there's a few different opportunities. You can always give cash, like through checks and through cash through the collection or whatever. But there's also stock donations that if you have appreciated stock, you can always have that given to a charity. You can have donor advised funds. So sometimes some of my people who can't itemize, what they'll do is they'll bunch up their donations for like 3 years or 5 years. And so maybe they give $25,000 all in 1 year, and then they, over the next 3 or 5 years or whatever, they're given to the various charities that they want to support. And then that way they're able to itemize, the charities are able to get a donation, and it helps reduce their taxes. Retirement, savings, planning, faith, and wisdom. So part of this I'm going to go through as a workshop, but basically we have traditional IRAs, Roth IRAs, 529 plans, 403, 401ks, SEP, simple IRAs, all sorts of different retirement options. But what I want you to do is we're going to put our faith to work. So there's some handouts here. After the first page, take one of these. In case I need it. So what we're going to do is we're going to have basically two choices. We're going to or three choices. We're either going to give $5,000 to a traditional IRA, $5,000 to a Roth IRA, or $5,000 to a 529 education plan. And then we'll make some assumptions there. I'll go back over that. But what I'd like you to do is just take a couple of minutes, and where it says step 1, go through what are your priorities. Do you want to reduce taxes now? Do you want to reduce taxes at retirement, or save for your children or grandchildren some money for their education? And just maybe break up in groups of 2 or 3 and just kind of say, well, why did you make that choice to someone else? Yeah, put your pens down. No more correct answers after this? No. So, how many of you guys said, name of the Father, Son? Okay. Anyway, let's see here. How many people said reduce taxes today? Okay. Maybe about a third. How many people said reduce taxes at retirement? Okay, probably more than the third. And then how many people said save for children's education or grandchildren's education? Got one, good. So all those are good to know your motivations and why you want to do that. Some people don't have children, or their children are grown up, so there's no reason to help with education. So then you have to determine between saving taxes today or saving taxes in the future, what's going to be better for you. So in the assumption I had, what we had is if you gave $5,000 to each one of these, a traditional IRA, a Roth IRA, or a 529 plan, you have put in $100,000 of your funds over 20 years. So that's a pretty significant number. And just using 10% might be the rate of return. Maybe it's grown to $200,000 after 20 years. So now what happens after 20 years? We're sitting year 2046. I can't even think about that. But anyway, 2046. So now let's say you're ready to retire. Might not be true, but we're going to pretend for this exercise you are. You put that money in, you reduced your taxes as you were going along, but now as you're trying to take out that $200,000, what's going to happen with that money? Is it taxable or not taxable? Does anybody know on a traditional IRA? Taxable. Okay, how about the Roth IRA? Now you just have that same $200,000. Is it taxable or not taxable? It's not taxable to take that money out. And then with the 529 plan, if it's used for education purposes, is it going to be taxable or not taxable? Tax-free. So I'm going to give you on that hidden page that I didn't want you to see. So now we got that $200,000. The traditional IRA, the taxes, when you take that out, at my assumption of 24%, you have to pay $48,000 of tax on that money you saved. So your net amount is $152,000. You did save $1,200 per year for 20 years, so that's $24,000. But you have no savings on the withdrawal of those funds. So your total tax savings is $24,000. The Roth IRA here, same $200,000. You take it out, you pay no taxes as long as you're of the right age. It's all tax free. The money has grown, and you got to keep that savings. Now, you didn't have any deduction on your taxes for making that contribution in, but you're now ahead $48,000 versus having an IRA. If you have a 529 plan, so now your priority was your children versus just having the retirement, that same $200,000, if you gave it to a qualified Colorado giving opportunity like College Invest, they give you a small deduction for that, and your savings on that's $4,000. So not as good as an IRA, but now if they use those funds for education or education type purposes, it's pretty broad in what you can use this for. It can be for housing, anything. Now they've saved $52,000. You've saved as a family unit, you've saved $52,000 in taxes. They've also changed in the current law that if you still had money in your 529 plan, you can still take some of that money out tax-free. And if you really still didn't need to use it, you can just have it roll over to a Roth IRA. Now your 529 plan is now a Roth IRA for your child. And they're able to have another 20, 40 years of tax savings, of growth that can have, and now they have a retirement. So don't think, and I forced it on you, don't think I can only do one of these three. You can do two of these three. So what I want you to think about is, which one do you think would be good for you? A traditional IRA, a Roth IRA, a 529, or some combination? And maybe make a note to yourself which one you're going to do. And then also think about what can you do this month. Maybe you open or review your retirement account or a 529 account with your advisor. And if you don't have an advisor, there's some advisors here. You can set up automatic contributions to any one of these. Now, if you're you're employed and you have a 401k, you can't necessarily contribute to this, but you can contribute to your 401k or 403b, whatever your work is offering you. But choose something. That way, you're making that cognizant decision to save something. Just think about it. If you go to Starbucks, just save one of those Starbucks. Instead of going, just make some coffee at home and save yourself $5 or $7. You review your tax rate and adjust as needed. Talk to someone like me or some other tax professional to see what you might need in particular for your situation, and then pray about your generosity. I could have talked more about the charity, but you're saving money for you and your family, but also may have some money that you're going to give to the church. I remember a talk a long time ago by Archbishop Chaput. He said, you should, as Catholics, we're not tied to just give 10%. But as a rule of thumb, it's a good idea. So maybe give 5% to your church, to your local parish, and then the other 5% give to various organizations. Maybe you give to Focus, maybe you give to Catholic Charities, whoever, or Knights of Columbus, whoever you want to give. Plan your giving throughout the year versus, I'll give something if I have something in my wallet. And then share what you've learned with your spouse and your family. If you're married, you probably should be talking about with your spouse if you need to make any contributions or talk about saving money for your children, whatever that is. It's good to be a team on whatever you discuss. So make sure you mark one or more of those items. Estate and legacy planning. So usually when I first meet a new client, I ask them, do you guys have a will? Do you have something planned on where that money is going to go? Because otherwise the government's going to figure it out for you, and it might not be where you want it to go. Make sure that you have the right beneficiary on there. I've had clients where two different things. One is they have their spouse there, but their spouse preceded them before their death, and they don't have a good beneficiary there, so it goes into their estate. I've had where someone was married and they got divorced, and they actually happened to pass, and the beneficiary was their original spouse. So that insurance money or that retirement money that went to their ex-spouse. So hopefully you're not in any divorces and situations like that. But it's good to look at it's good to look at who you have down and making sure that you're intentional about where that money's going. Or if your estate's big enough, maybe you set up trusts and talk to an estate attorney or a tax accountant. You want to avoid any unnecessary legal burden, because if your family has to go to probate, then they have to pay an attorney to go through this, come up with paperwork, and you could have just avoided a lot of that by just having a will and having everything go the way you wanted it to go. And then also, I've had clients that will put down $100,000 to my parish, $50,000 to this religious order, whatever. You've thought about it. I have a new client that he's actually going to give almost all his wealth to a Catholic organization and not give anything to his kids, because his kids are already married and they're in a good situation, and that they don't necessarily need it. He has made these plans with his wife, and that's what's going to happen at the end of when they pass on. So I've got a few quotes from Rerum Novarum. I really love this document. It's over 100 years old. It's from Pope Leo XIII. So when a man engages in remunerative labor, the impelling reason and motive of this work is to obtain property and to dispose of it just as he pleases. So we receive our money, we get to choose, in this country, we get to choose where it's going to go. I want you to think about where your money is going. That really tells yourself, and it tells God, what do you really trust in? What do you really believe in? Every man by nature has the right to possess property of his own. So we're in a free country. We get to own our home. We get to own cars. If we're into boats, whatever, we are entitled to own property. But man should not consider his material possession as his own, but as common to all, as to share without hesitation with others in need, of which he may remaineth gives alms. So that's not communism. What he's saying is, you should not let this just sit with you and be like Ebenezer Scrooge, where the money is just to collect. You want to be able to share this with your family, with your church, with whoever else that you see in need. Whoever has received from the divine bounty a large share of temporal blessings has received them for the purposes using them for his benefits of others. So just as we have received grace, just as we received God's forgiveness, we've received all these different types of gifts from God. We've received our wealth, our jobs, our families, not necessarily a family part, but for what I'm about to say, but we pass this on. We want to share what we have in our wealth. We want to plan about what we want to do and be intentional with what we have. Not sit here at 100 years old, or if God willing, and say, well, I didn't help anybody. I've got this big pile of money. I've got some gold bars, and that's all I got. You want to be able to share with where God's calling you to do as well. So some final reflections. What steps are you called to do? From your calling as either married, single, you have kids, you have grandkids, maybe great-grandkids, whatever it is. What are you going to do intentionally with your money? And then how can what you choose support your vocation? And so maybe you need to, like I said, sit with your wife or your husband. Maybe look at where your kids' maybe aptitude is. Maybe they want to go to engineering school or an attorney or a doctor. It's going to cost a lot more to send them to college than it is if they are just going to do a trade school or maybe a local state school or something like that. So make those decisions now.